Welcome to Clutch Radio. Before we jump in, just a quick disclaimer. This content is AI generated and fact-checked. It's for education and entertainment purposes only, and it is not investment advice. Welcome back to the Deep Dive. We've got a special segment for you today, Clutch News, and it's presented in collaboration with Concordia University, Irvine.
And the timing is really something.
It is, because politics and portfolios are colliding again, in a big way. Did you see the latest from President Trump? One social media post and boom, Wall Street felt a serious downdraft.
Oh, yeah. It definitely it woke the markets up. The catalyst was a post Trump made on Truth Social.
Right.
He's calling for a temporary 10% cap on credit card interest rates. And he wants this to kick in on January 20, 2026.
Okay, so for context, what are rates at now?
Well, current average rates are hovering somewhere around 20, maybe 21%. So he's basically talking about chopping that revenue stream in half.
In half. That is a massive slash. And looking at the charts, it seems like the banks took it pretty personally.
They did. Lenders like Capital One, they dropped about 6%. Synchrony Financial, which does a lot of those store brand credit cards, they tanked about 8%. The market logic is pretty straightforward.
Yeah.
You cap the price they charge for lending, you cap their profits.
But here's where I want to dig in a bit. We're not just looking at the banks. We're looking at Mastercard, ticker symbol MA.
Right.
They dropped to about 1.6% down to around $566. But are they really in the same boat as the banks?
Not at all. And that's the key misunderstanding we need to clear up here.
Okay.
Think of the economy as a big highway. The banks are the ones financing the cars. But Mastercard, they're the toll booth. They just provide the rails that process all the payments.
So if I don't pay my credit card bill, the bank is the one sweating, not Mastercard.
You got it. Exactly. Mastercard doesn't assume the credit risk. They collect a small fee every time a transaction happens, regardless of whether you pay off the debt later.
Just the toll collector.
Just the toll collector. And because of that, their financials look drastically different from a bank's.
I was looking at the data from FinViz earlier, and I saw some pretty wild numbers on their margins. What's actually going on under the hood there?
It's impressive. FinViz reports their gross margin at nearly 97%. That is what someone like Warren Buffett would call a moat. It just shows immense pricing power.
Okay.
And then you look at their return on equity, or ROE. It's over 185%.
Okay, hold on. For everyone not glued to a Bloomberg terminal, what does an ROE of 185% actually mean?
It's like an efficiency score. For every dollar shareholders put into the company, a good company might generate, say, 15 or 20 cents of profit.
Right.
Mastercard is generating nearly $2. It's a capital-light money machine, completely unlike a bank that has to keep piles of cash in a vault to cover bad loans.
So play devil's advocate for me. If they're just the toll booth and they're that efficient, why did the stock drop at all? Why did investors panic?
It comes down to traffic volume. Even if you own the best toll booth in the world, you need cars on the road to make money. The fear is that if this 10% interest cap becomes law, banks will simply stop lending to riskier borrowers.
Right, because if you can't charge high interest to cover the risk of me defaulting, you just don't give me the card in the first place.
That's the danger. If banks stop issuing cards to subprime borrowers, say people with credit scores under 600, the total number of swipes goes down.
Less traffic on the toll road.
Less traffic on the toll road means fewer fees for Mastercard.
So is that a permanent problem, or is this just the market overreacting?
Most analysts seem to think it's an overreaction. They're viewing this as a buy-on-weakness moment, pointing to a target price closer to, I think, $664.
Okay.
The thinking is that Mastercard's position in the global payment infrastructure is just so sticky that one policy change in the U.S. won't derail the whole train.
Let's zoom out a little. We talk a lot about the economic machine on this show. Why do these price controls like capping interest matter to the average person beyond just stock prices?
It goes right back to basic economics. Price controls are often called the invisible hand in reverse. Prices are signals. They tell us about risk, about supply and demand.
And when you break the signal?
When you artificially cap a price, you break the signal. In the real world, that usually leads to shortages. In this case, it wouldn't be a shortage of bread or gas, but a shortage of credit. The very people the policy is trying to help might suddenly find they can't get a credit card at all.
It's that cycle of regulation and reaction we see over and over again.
It really brings to mind that old Mark Twain line. History doesn't repeat itself, but it often rhymes.
I like that.
We keep trying to control market forces with these caps, and the market keeps responding by restricting supply. The rhyme scheme is pretty consistent.
So to wrap this all up, the banks are taking the direct hit because they actually own the debt.
Correct.
Mastercard is taking a sort of sympathy hit because of potential loss in volume, but their toll booth model is still fundamentally robust.
That sums it up perfectly. The political noise is about the lenders, but the infrastructure itself remains very strong.
A provocative thought to leave you with: if banks do stop lending to risky borrowers because of a cap like this, where do those people go for cash? Do we see a return to physical cash, or maybe a surge in unregulated predatory lending? Something to chew on. Thanks for listening to the Special Clutch News segment. And just a final reminder, this content is AI generated and fact-checked. It is for education and entertainment only and is not investment advice. See you next time. Thank you for listening to Clutch Radio.